concentrate today on is a shortish presentation on balanced funds and how we firmly believe balanced funds should be managed. They're a key part of the solutions for clients. They're obviously Reg 28 products, a Reg 28 environments that one sits in. One has to be within a Reg 28 balanced fund. I think the different parts of the industry which are starting to try and unbundle those balanced funds and make them into different parties to do different things. We firmly believe that one asset manager, one investment manager should be managing the entire balanced fund in an integrated way, thinking about the fixed income side alongside the equities, which are the two main asset classes, which I'll get into in a moment, and thinking about global and local seamlessly. I really think it's critical that it should be managed in an integrated way. And so I want to go into a little bit of the background to that and then go into the various building blocks that and our approach within each one. So first off, the necessary components of a successful balanced fund in my strong opinion is firstly to have a deep understanding of the primary asset classes. And this is where the bulk of what I'm going to talk about sits. But I think there's a lot of our industry is fraught with making things too complicated. And what I want to try and do is simplify the thinking around asset classes, because in essence there are only two. And I'll try and show you why I think that and how those should really be used. The second thing is within those two, which are basically equities and fixed income, to have your equity component generating not just the equity part, which through time is the bulk of a balanced fund and should be, because it generates the best real returns through the long term for a wide variety of reasons. A bit volatile from time to time, but long-term investors can definitely stomach that. And within a balanced fund, your clients can definitely stomach that because you've got the other component that's less volatile. But to have, in addition to what the market gives you, which is real returns, to have in addition some alpha, an outperformance of that. I think that's critical. And when I look around our balanced funds and where the bulk of money sits in this market, I see that the bulk of them sit in very large balanced funds, where the equity component, in my view, and when one looks at the evidence, is not generating alpha in addition to the equity market. So that's important. The second asset class is really the fixed income or yield asset side. And there, I think a key part of a balanced fund is not to go to a specialist fixed income manager or bond manager who are, in my view, and when looking at it, some of the more conservative benchmark cognizant investors in our market. They think they're pushing the boat out if they put the duration relative to the all-B out to 1 year or just over 1 year. Whereas, so they're extremely benchmark cognizant. Whereas relative to the risk you take in the equity portion, the fixed income portion is tiny, the risk is tiny. So you can take, when the yield is high, or when there's opportunity, which there was 2 years ago, 18 months ago, you should take a lot of risk in this area. And relative to your equities, the risk is tiny. There's lots of return on offer there. So a valuation-driven, in other words, looking at the expected return-driven approach and integrated with the equity thinking, I think is key. And then obviously tying that together, an integrated, optimized asset allocation framework, which is looking at how you blend those two major asset classes together. Those are the key components of a balanced fund in my view. So just unpacking those, the primary asset classes, and why I say they're two primary asset classes, is because they have very different return profiles. And most investments out there can be put into one of these two categories. So on the left-hand side, for those of you who remember your statistics, this is the probability on the y-axis, and this is your potential return. And on equities, you have a wide potential return, expected return, very wide, and in fact, uncapped can be very high, and it can go down to zero. So it's wide. But the average, the expected return, is high, and high in real terms. Whereas on the fixed income side, you have a high probability of a definite return. You have virtually no chance, well, you have no chance of getting more than that. You have zero chance of getting more than that. you've got a little chance of getting less because you've got credit risk, and credit and fixed income counterparties can renege on their contract with you, and you either get the guaranteed return or you get less. So it's a very different profile. The other thing is that the expected return is lower than the expected return in equities. Now that's all I think you really need to know about asset classes. But just unpacking it a little bit more, on the ownership or equity side of the asset class spectrum, of the two asset classes, there's no promised return. There's nothing that's promised when you invest in NASPAS or Anglo-American. You are entitled to the residual profits after the employees are paid, after the debt's paid, after other expenses are paid, after all the fixed costs and other variable costs are paid. You're entitled to the residual. And that's why it's unlimited and uncapped, because residual can be very large. So there's a wide range of outcomes, as I said, uncapped upside, and it's better for playing the offense. And in the long run, most clients should have a big part of their assets on the offensive side, because you can tolerate volatility in the short term. On the other side of the fence, you've got a contractual relationship. This asset class is totally different. You've got a contractual relationship. That contract can be for various terms, and it can be floating or fixed, but it's contractual. It's a fixed outcome investment rather than income investment. It's a fixed outcome investment. It has a narrow range of return outcomes, so you can see that probability distribution is quite narrow, and it ranks above ownership. So if the investment you make is in an XYZ, Standard Bank deposit or something, the deposit's going to get paid before the equity gets a dividend. It's better for playing the defense. So in more defensive times and in defensive environments, or for more defensive clients, you want more of that. And in essence, that's asset allocation, is an interplay between those two things. So putting it together and blending it to get your desired risk profile, I would put it to you that the most important thing, and you guys know this, the most important thing for your clients is to identify their targeted risk exposure and risk posture. So what is their risk tolerance, and what's their risk profile, what's their circumstances? That's the most important thing. And then given that, one can then blend the asset allocation to cater for that risk posture. And that's basically the degree, the balance between aggressiveness and defensiveness, between equity and fixed income or fixed outcome, between preserving capital and growing it. It's that balance. And it's what I'm talking about is choosing a type of fund that marries your client's needs and risk profile with the average asset allocation of the particular fund you're targeting through time. The absolute risk level must be consciously targeted, and it's the optimal mix of those two asset classes. It's an optimization exercise, not a maximization exercise. As you all well know, you're not going for the best return for your clients. You're going for the optimal solution for their risk posture. And it's based on things that you guys know and deal with all the time. Time horizon of the investor, are they drawing down regularly? Their financial condition, do they have lots of money, or are they tight? Income needs, aspirations, and their psychological risk tolerance. That gets you your risk posture, which ultimately sets your desired mix of ownership and fixed investment, fixed interest. So blending it together to get that targeted risk profile, and excuse me for the slightly complicated looking charts, but basically what you're doing, your expected risk and expected return are increasing as the ownership or equity side goes bigger in the mix. So basically what you're moving is moving from those narrow, more limited, lower outcomes to the wider with more risk. You could have, the risk means you could get a much worse outcome. It doesn't necessarily mean your return is going to be higher. You're taking the risk. And so it's a blend of the more equity you put in, the more you're getting towards that broader equity-like probability distribution. So that's the job of asset allocation. The other part to it is a more subtle one, and I mentioned it a little bit earlier, is the role of the expected returns in the environment at the time, and the degree to which you're able to pick a skilled manager who can outperform those asset classes. So the role of expected returns and alpha. So on the relative return side of things, there are some environments or some times when there's quite a lot on the table and the expected returns are high. And in particular, the expected returns can be very high on equities. And that's a very good time to be leaning more on the asset allocation side into the equity side. And there are times when there's less of that, like perhaps now when we're sitting at an all-time high, where perhaps you should be leaning a little bit more into the yield asset side, be more defensive, more offensive times and defensive times. Is the market high or low? But the other part of it is, are you able to select a skilled manager who can reliably through time generate alpha? Because if you can generate alpha, and if you can get a skilled manager who can do that, you can actually potentially target a different risk profile. Because if you can get higher returns, you could either get lower risk for the same return by using a more skilled manager, or you could get higher return for the same risk. And so that makes your choice a little bit a bit different. If you can get a skilled manager, perhaps you could go for a high equity multi-asset class fund rather than a medium or low equity, because you're getting you can potentially get the same return for lower risk if you blend it appropriately, or a higher return for the same risk. So, and what I put to you in the final two sections of my talk, which are much quicker, we add value in both. And over the long term, we can show we've got track record in the alpha side and the equity side, and in bold valuation-driven fixed income, which have both added value to our balanced fund. So putting this last slide into a picture, and that same picture, sometimes there's lower relative expected returns from the debt portfolio or the fixed income side, and the picture looks like that, which is a typical picture. So that the expected return from bonds or fixed income or income funds is much lower than the expected return for equities. But there are other times when there's higher relative expected returns, either when the equity market's very high, or when yields are very high, the yield curve's very high on fixed income. 18 months ago, 2 years ago, those of you who were in a similar room to this would have heard us say that there was, in our view and in our portfolios, an extremely high expected return outcome, forward-looking potential in our equities and our fixed income at the same time. So we had a unique opportunity where we had a huge amount of upside on the equity side, we thought, and a huge amount of upside on the yield asset side. The yield curve was, and I'll show you in a moment, was 13% at the long end. It's now 10. That's a massive move down. Those of you who deal in fixed annuities would know that annuities have never been so good as 2 years ago in terms of how lucrative they were. But also in our portfolios, we thought we had a huge amount of lowly priced equities. So it was and we had a very concentrated portfolio, much more in, and I'll show you in a moment, SA equities and SA very long bond. And much of that has come to pass over the last 18 months or so. So putting it all together, the asset allocation decision process is between those two asset classes, ownership and debt. And most asset classes, whether it's infrastructure, can mostly be equity, or it could be debt. Or global equities, that's equity. Global debt, global yield assets or bonds is yield. It's very simple, those two asset classes. Considering the risk posture, and you put that together, you balance them together, considering the risk and return, that you can get on the various asset classes, what's available in our market, and in our market there are many parts of the asset classes that are very, very constrained in size. So property, there's very small property sector, it's very small credit sector. Credit instruments are tiny relative to the amount of capital out there, and very overpriced at the moment, as an aside. And putting together the optimal portfolio. So that's the asset allocation side, and in our view, a simple, but I think an unusual, but I think completely logical and rational way to approach asset allocation and to think about asset allocation and balance funds. And with that context, I think it's, given that it's an interplay and a balancing act, it's very hard to think that an outcome will be better if different managers are doing different parts of that. I think it needs to be an integrated consideration and that balancing needs to be integrated. So moving on to those second, third, and fourth sections of my talk, the alpha generating equity capability. I'll be a bit quicker now and hand over to get our panel up on stage. But our equity approach is proven. We're the number one equity manager over 21 years in South Africa, general equity manager. and we have been in the top 3 for most of that time throughout that 21 years. It's a valuation-oriented equity strategy. In other words, we very much focus. If you think about equity investing, it's you could be focusing on what things are worth and what prices are going to do, and trying to have a view on what prices are going to do. So we focus 95% of our time on what things are worth, the economic reality, and very little time on what prices are going to do. So we have no insight into the timing of things and when prices are going to move, but we do know what they are. Very important that the price that you pay is lower than what you see the value of the prospects. And we're somewhat contrarian in that we very much take advantage of an inefficiency the market gives us, which is driven by human psychology, which is that humans generally get overly excited and get crowded around optimism, and that embeds in prices, and prices go too high when things are going well. And they get crowded in pessimism when things are going badly and prices go way, way too low. So we lean into exploiting that human psychology inefficiency that we see by being somewhat contrarian. We focus on cash flows, which we firmly believe are the economic reality, not accounting profits. We exploit, as I say, crowded sentiment, whether it's optimism or pessimism. We concentrate on the long-term prospects, and what I mean by that is not necessarily that we have a long-term outlook and we forecast, which we do, but what I mean is we're not spending most of our time thinking about what's just happened, where there's a lot of information about what Trump and Xi Jinping said to each other last night, or what the Fed did yesterday, or what they're going to do next time. There's a huge amount of focus on that and a huge amount of information. You could spend a lot of time doing that. And it's much more difficult to think about what's the China-US relationship going to be in 3 years, 5 years, 10 years? Where's the Chinese economy going to be? What's the interest rate yield curve going to be longer term, and where should it be? So those sort of things are much more ambiguous. There's a lot less information about it. A lot fewer people are thinking about it, and therefore it's much more lucrative. It's harder to do, but much more lucrative in our view. We probabilistically, therefore, contemplate alternative scenarios. We have no insight really into the future. But we have a well-informed view on likely scenarios, and we think about what those probabilities are, and we weight up our portfolios accordingly. We invest with discipline according to our approach. It's often really hard and lonely and uncomfortable to be on your own with a particular view. To have platinum stocks 18 months ago was very lonely. To have 20-year government bonds was very, very, very lonely 2 years ago. But they've paid off massively for us. And at one point, it was very lonely to have Prosus because that was seen as uninvestable. China was seen as uninvestable. But it's always important, and probably the most important thing for us is to have humility to change our mind and to know that we're not always right, and that we must continuously be paranoid that things that we think are wrong and we need to change. And then I think the final point, which as I said on our last roadshow, and I think it was a virtual one, was to have a high active share, to have the sound thinking behind your investment ideas, but then to take a big position relative to the benchmark and relative to the competition, which is a key to outperforming in equities. Is you have to be very differently positioned and mostly right. And when I say mostly right, just above 55-60%. And by doing that, having one of those two being right, but being very narrowly focused around a benchmark is not going to get you much alpha. And being very widely positioned relative to benchmarks and the competition and being wrong is also going to get you nowhere. So taking a high active share position with conviction. So talking about active share, this is put up at the Meet the Managers thing just not too long ago, which some of you may have seen. But it's basically this active share measure on the y-axis is the degree to which we are different, and different to benchmarks or different to the competition. And so this shows us over the last 10 years how our equity portfolio, the equity carve-out portion is a very high active share. So I'll just tell you in a South African context, 70% is very high. Very few managers run 70% active share. So that's the sum of all the active positions, the absolute sum of all the active positions. And then what we do is we just graph at the most recent date what the range of active shares are for the 4 largest SA equity, or South African equity, general equity unit trusts are in the South African market. And you can see the highest is just over 50%. and the lowest is just over 30% of the largest, where the bulk of the market share sits in our market. Now, that's much lower, and if they are right, they're going to generate for you much lower alpha, as it's just a mathematical fact. But what's even worse is if, as a lot of people do, you blend those four big managers, which clearly by the size of their assets, a lot of people are doing, or blending at least a big portion of those, you blend away the idiosyncratic active share and you get closer to passive. So that green dot is if those four managers, the four largest managers, equity managers in our market, you blend them together in equal weight at 25, 25, 25%, you get much closer to a passive, because passive is 0% active share. So you get down to a 20% active share. So you're diluting away any potential for alpha. This is our consistent long-term performance that I just wanted to show you. Our equity alpha fund is turned 21 recently. It's number one out of the 19. In fact, it's 26 funds if you include all the general equity funds. This is just the SA. This is the category with global in it, and substantial outperformance of the competition. The peer rankings are there over 3, 5, 10 years, and since inception is 21 years. And this is just a graph of the yearly rolling alpha. So this is every month, 12 months looking back. And that looks like the alpha is reasonably sporadic, but it's actually the interplay between what the market's doing, which we have no control over, and what our portfolios are doing. But if you look at 5-year rolling alpha, it's 86% of the time our 5-year rolling alphas have been ahead of the benchmark. So that summed up together over the long term means number one fund over 21 years. Then moving on to the yield asset or fixed income side of the equation. How we do things is very similar to equities. In other words, we value things, but in the yield asset world, you just flip it over and you're thinking of not perhaps the share price over earnings or cash flows. You're thinking about the reverse, which is the cash flows over the price of the asset, so the yield. So what we're continuously doing is comparing what we get in the market price, the market yield, with what we think the yield should be across the yield curve. And to the extent that there are yields that are in excess of where we think they should be, that's what informs our positioning. And as I said 18 months ago, with 13% on the long bonds, and I'll show you in a moment, we were positioned mostly in the very long end of the curve. We build that valuation and we dissect the market pricing into various components. And I'm not going to go through in too much detail, but the global risk-free rate plus South Africa's credit spread as a country, South Africa's currency risk premium or inflation risk premium, in other words, the spread that you need for investing in rands in our bonds. And then if you're going into the corporate domain, some further credit spreads. So that's what informs our valuations and our consideration of the prices. And as I say, over the last 18 months, it's been a very dynamic and very aggressive yield assets strategy that is, I think, if one's managing it on its own as a conservative, benchmark cognizant bond manager, you're not going to be doing. But we had 24.3% of the balanced fund sitting in the 20-year region 18 months ago. Giving you 13%. You can see the yield curve there. This is through time. So it was in that general region, over 13% for 20 years that you were being guaranteed by the South African government. And that's given us that particular bond, the 2044, has given you a 31% total return over that last little while for a bond. And we've now moved substantially into the 15 and sort of 7-year region, and have much more conservative yield asset positioning, given that the yield curve is much lower. Finally, putting it together in terms of asset allocation skill, this is just what we've done over the last 12 years or so. It's reasonably busy, and I'd concentrate more on the right-hand side of that, which you can observe, and I'll show it more in a sec, is that SA equities have gone down a lot. We had a lot, now they've gone down. Global equities are up a lot. SA bonds, it's not that apparent here, but we've moved from the long end to much more the short end. And our hedging, it's also not fully apparent here, but the hedged equity is at the highest point in terms of notional of the fund that's hedged that we've had over the last 12 years or so. This is the equity progression, just showing you the global equities is the light blue, has gone up a lot, and the hedge is reasonably substantial. That doesn't show you the full portfolio that's hedged, but that's the immediate delta. And then the yield asset progression, what we were doing a lot is in this orange area was having credit instruments, giving you a credit spread, and then lengthening the duration and turning it into a long bond via bond futures. And we've stopped doing that and moved only into bonds. So that's the range, and I'm not going to go through that too much detail. This is just graphs the global equity percentage of the Camissa Balanced Fund, and this shows us relative to the average balanced fund out there. We've been higher most of the time and are now at pretty much 40% in global equities in the balanced fund. So just quickly looking at our track record in the balanced fund, the rankings are at the top there, right at the top in terms of rankings relative to competitors and substantial real returns over the long term. Completing the range, our multi-asset class funds, the ones with lower risk profiles for lower risk postures, as I said earlier, also really strong rankings, number ones or twos throughout for our protector fund and stable fund. Substantial real returns delivered there. So the final point I wanted to make was just a point that continuously frustrates me, is that our stable fund is not bigger. And the conversation with the sales team is always that everyone wants, for living annuity drawdowns, you want to have income funds, you want to have no movement, you want no volatility. What I just wanted to highlight is that volatility is not risk. Volatility, I think, should be part of a living annuity drawdown, and you can get much bigger drawdowns through the life of your client if you tolerate a little bit of volatility and have go slightly up the volatility spectrum, not the risk spectrum. So this just simplistically shows STEFI, which is the cash return, real return, total return over the last 4 years or so, and then that 20-year long bond. And what you can see is that through times when the long bond's not doing too much, they keep pace. So it's fine. It's exactly the same thing. It's just you have a little bit of movement, a little bit of volatility, which gives you the same sort of return, but with a little bit of bumpiness, but substantial potential for capital gains or outperformance if that yield curve moves down. If you're in it at a point where the yields are very high, and this just looks at a similar thing, but our stable fund versus the average income fund in the market. And that income funds, I'm told, is where the living annuities drawdowns are sitting. And I know that category is growing massively and is very large now and has compressed credit spreads massively. So a lot of the returns are in the rearview mirror. But this just shows you most of the time we're ahead. There is a little bit of volatility in that. It's into equities and longer dated instruments, but the potential for substantial outperformance is huge, and your client can live a much better retirement as a result. So, yeah, in summary, I think balanced funds should be managed in an integrated process. Alpha in equities and yield assets is a key addition, and I really think you need to choose a manager who has skill that's able to deliver that. Following extraordinary performance, our positioning is now very different. That's the one thing I wanted to try and highlight and get out there. Is what goes up doesn't necessarily come down. And we have moved substantially within our portfolios in asset allocation and in selection. And I've shown you a little bit of that progression through time. We're very differently positioned as to how we were 18 months ago, and much more defensively, much more on that defensive posture than the offensive posture. And I think our market-leading track record is evidence of our pedigree, and I think we really should belong in the mix within blending of balanced funds.